April 15th has come and gone. For most, that date feels like a finish line. You send off your return, assume your file is closed, and move on with your year. But right now, in the weeks following tax season, the IRS is just getting started. This is when their advanced automated data matching systems activate, cross-referencing everything you reported against data from banks, brokerages, and payment platforms. Relying on old assumptions that your income is fixed and protected leads directly to compounding financial penalties that trigger long after the tax season ends. Look at this comparison of what most retirees expect versus the actual 2026 reality. You expect an untaxed Social Security check and a closed file. Instead, the 2026 reality scans for taxable benefits and Medicare surcharges. We will look at the 3 automated checks causing damage: static Social Security thresholds, 1099K mismatches, and delayed Medicare premium spikes. Because the IRS relies almost entirely on automated computers to flag these discrepancies, passive compliance has become a financial liability. You have to actively structure your defense before the system flags you. Let's start with the money most people assume is completely untouchable. Most seniors believe their Social Security benefits are immune from federal income tax. That was largely true in 1984, which is the exact year the government set the income limits for taxing those benefits. If your combined income crosses $25,000 for a single filer or $32,000 for a married couple, up to 85% of your Social Security check becomes taxable. This chart shows exactly why this is failing retirees today. The flat line is that 1984 threshold, which has never been adjusted for inflation. The rising curve shows the high cost of living adjustments from the past few years: 8.7%, then over 3%, and 2.8%. Those larger checks pushed millions of retirees over those ancient limits for the very first time. You didn't get wealthier, but the math says you did. If you don't have federal taxes withheld from those payments throughout the year, the IRS computer hits you with a massive underpayment penalty. To fix this, you need to submit Form W-4V to the Social Security Administration. This lets you request a voluntary tax withholding of 7, 10, 12, or 22% before the next season hits. You have to weigh the options: accept a slightly smaller monthly check right now, or risk a severe automated tax bill later. The next automated trigger hits seniors participating in the digital economy. Many retirees sell old furniture, vintage clothes, or collectibles online to downsize. If you sell on platforms like eBay or Facebook Marketplace and receive more than $600 total across the year, that platform automatically sends a Form 1099K directly to the IRS. It has your name and Social Security number attached. When the IRS matching system scans your return, it looks for that exact 1099K. If your tax return doesn't perfectly match the platform's data, the computer automatically generates a CP2000 notice for underreported income. Selling personal items at a loss is not taxable. If you bought a couch for $800 and sold it for $200, you owe nothing. But the automated computer doesn't know what you originally paid. It only sees $200 of gross income reported by the platform. To explain the mismatch, you must report the sale on your Form 1040. This creates an administrative requirement to track down original purchase receipts to prove your cost basis to the IRS. Ignoring those small online sales provides temporary convenience, but guarantees the grueling administrative burden of defending yourself against a manual audit later. The most devastating trap for retirees involves taking a one-time large withdrawal from a traditional IRA. This is a logical decision to pay off medical debt, help children, or renovate a home. You pay the income tax on that withdrawal and think the transaction is over, but exactly 2 years later, a stealth penalty activates. Medicare calculates your Part B and Part D premiums using your tax return from 2 years prior through a system called IRMA. If that withdrawal pushed your income above the threshold, your Medicare premiums instantly jump. For a married couple, this can add up to $886 a month in surcharges, deducted directly from your Social Security checks for an entire year. This is a double hit. That same IRA withdrawal artificially inflated your combined income for the year, which forced even more of your Social Security benefits into the taxable zone. You get a higher tax bill today and a massive healthcare surcharge 2 years later. If your income spiked due to a one-time life event like this, you have a defense. You can appeal the surcharge using Form SSA-44. Tapping into immediate IRA liquidity solves today's problem, but triggers unbudgeted healthcare and tax penalties down the line, unless you are prepared to appeal. While the IRS system is automated, there is an equally dangerous threat in 2026. Operating outside the rules, scammers are using AI voice cloning technology to impersonate family members or tax agents. These callers claim that your recent return triggered an immediate investigation, demanding you pay fabricated penalties using wire transfers or gift cards to avoid arrest. Remember the absolute rule. Authentic IRS contact is always initiated by physical mail. They never call, text, or email you first. If you get a suspicious call, hang up immediately. Because the IRS enforcement mechanisms are entirely automated, proactive document filing is the only way to protect your retirement assets. Map your defense to your profile. If hit by COLA increases, use Form W4V. If selling online, track your original cost basis. For lump sum IRA withdrawals, file Form SSA-44. These precise actions neutralize automated triggers before penalties can be applied. We are also watching for systemic relief. The October 2026 budget reconciliation will determine the fate of the You Earned It, You Keep It Act, which could completely eliminate federal income taxes on Social Security benefits. Maintaining an active, year-round tax strategy serves as a necessary shield to preserve the retirement wealth you spent your whole life building.